stuff they're going to do next will be more extreme versions of what they're doing now, and it'll be okay, because the old stuff was pretty successful, all things considered. We're not in 1930s style depression. And they want you to ignore the fact that it required, a doubling of the U.S. national debt, an almost quintupling of Chinese total debt to get us here, and a huge increase in debt and unfunded liabilities in Europe. We needed to borrow huge amounts of money, historically huge, unprecedented amounts of money, to keep things going. And going forward, we need to continue to borrow even more money year after year after year. At some point, there are no tools to stave off the debt collapse that comes from this kind of leverage. If we, going into a recession, already have record consumer debt in the U.S., record auto debt, record student debt, record corporate debt, and record government debt, taking on huge amounts of new debt is probably not going to be the thing that brings back the normal times of the 1980s and 1990s, when we basically, grew steadily and there were lots of jobs. Those times can't come back under the current regime.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with your SD Weekly Metals and Markets Wrap, and with us today is John Rubino from dollarcollapse.com. John, thank you so much for joining us today.
Hi Elijah, it's good to talk to you again.
All right, great. Well, the first topic I'd like to discuss today is the precious metal markets. What's your perspective on the recent price action? This week, both gold and silver are down just slightly.
It has been so boring lately in precious metals. The gold bugs of the world have been waiting for the next explosion in price and watching every fiat currency indicator out there that usually correlates with gold and silver prices go through the roof. We're creating an accelerating amount of new debt in the world on top of this mountain of debt that we already created in the last 30 years. It's getting worse and worse from the point of view of systemic leverage pretty much wherever you look. And that's usually really good for precious metals prices because gold and silver are where you hide out when governments are screwing up their currencies. And by any measure that you want to use, the screwing up of the world's main fiat currencies is accelerating, but gold and silver aren't taking off. And that's frustrating, to say the least, for people who correctly interpret what's going on out there is really dangerous and bad, and look at history and see precious metals as the safe haven in these kinds of circumstances. And it's not happening right now. You've got other kinds of assets absolutely going through the roof. For instance, there was just a painting that sold for almost $500 million. Paul Newman's old wristwatch sold for $17 million just lately. And that goes on and on. The collectibles market and fine art and other things that are related to collectibles that rich people tend to put their money into as an alternate store value, those things are going through the roof. But gold and silver aren't. So they're kind of being left out. And it's not completely clear why. There are a lot of theories out there. It's being manipulated by governments because gold in particular is a competing currency. When it goes up, it makes the dollar and the euro and the yen look bad. So it's in government's interest to depress the price. That's one theory. Another theory is that the rise of Bitcoin and the other cryptocurrencies are siphoning off a lot of the flight capital, the safe haven money that might otherwise have flown into gold and silver. That's possible too. And it's also possible that this is just one of those times when something takes longer to work out than you would think that it would, of which we've seen a lot in the last couple of decades. It always seems like bubbles are going to burst long before they actually do burst. And I have a painful personal history of being too early with bubbles. I wrote a book on the real estate bubble in 2003. The real estate bubble didn't burst until 2007. And James Turk and I wrote a book about gold in 2004, and gold didn't really take off until 2008 or so. So it takes a lot longer for these things to work out than at least seems reasonable to me and people like me. This just might be another one of those times when the stock market is way ahead of itself by any historical measure. We should have a stock market bust. We should have had one already, but it hasn't happened yet. Gold and silver are fundamentally undervalued when you compare them to the amount of fiat currency that exists in the world. But that fundamental undervaluation hasn't been rectified yet. They haven't gone up to the point that you can look at them and say, okay, based on the amount of paper that's out there, gold and silver are fairly valued. We are nowhere near that. Gold would have to be about $10,000 an ounce for it to balance out the amount of dollars and euros and yen and yuan, et cetera, that exist in the world right now. So based on, my own experience and longer financial history, imbalances eventually do work out. Fundamentals are the things that eventually determine value out there. And so I think we should still be confident that gold and silver are going to have a monster run at some point in the not too distant future. But it's hard to, it's hard to sit there while some other things are going up and not feel very impatient. I feel for the people who own junior mining stocks right now, or have a lot of bullion sitting in various places in their house and safe deposit boxes and vaults overseas. These things aren't up the way a house in most hot markets is today, and as tech stocks are. And there are a lot of other things you could have put your money into 5 years ago that would have done a lot better than gold and silver. But the gold bugs of the world, we have to console ourselves with the expectation that those trends are going to reverse at some point. Gold and silver will wildly outperform Google or Tesla in the not too distant future, and probably outperform Bitcoin because gold and silver constitute the really undervalued asset in this marketplace right now. And undervalued assets tend to do better than fully valued or overvalued assets as everything is working itself out. So I think the next few years will be great for gold and silver, but we have to be patient until that trend really gains traction.
Definitely. And as you were saying, that, you sometimes have predicted crashes a little earlier than they've actually happened, but as they say, it's better to be a lot too early than, just one day too late. One of the things, though, that you've talked about that seems to be signaling that a recession is coming is the yield curve right now and how rates are compressing. Can you talk about this?
Yeah, one of the signs that we're near the end of this cycle is that the yield curve has become front page news, and that is something that almost never happens. There's a stretch of maybe 6 months at the end of big cycles when the yield curve becomes interesting to the financial press, and this is one of those times. You're seeing stories out there on almost a daily basis, checking in with the yield curve and telling us what's happened. The reason for that is that the yield curve is starting to change dramatically. Now, what the yield curve is the difference between long-term interest rates and short-term interest rates. And the theory behind its relevance is that banks make money by borrowing for short periods of time at low interest rates and then lending that money out for longer periods of time at higher rates. They make that spread, and when the spread is wide, in other words, when long-term rates are a lot higher than short-term rates, banks can make good money. And so the financial sector is very healthy, and you get spillover effects into the rest of the economy, which leads to a recovery. At the peak of cycles, however, the yield curve tends to flatten and then invert. In other words, long-term rates fall below short-term rates because people are expecting a slowdown in the credit markets, and so they buy long-term bonds really aggressively, which pushes down the yield of long-term bonds, and that leads to the yield curve inversion. That usually is followed by a recession a year or two later when the yield curve inverts and it's negative. Now, we're heading for that point right now. We're still a little bit positive on the yield curve, but it's heading for zero pretty quickly. If we have the same trend in place for the next month that we had for the last month, we would probably be about zero. And at that point, you can start using the yield curve to predict a recession, because it has predicted recessions pretty consistently over the past few decades. And so that's got a lot of people worried who have a sense of history and who are paying attention to this indicator. They're a little spooked right now. And so it certainly bears watching. And, when you and I talk next a few months from now, we'll have a very good sense of what the yield curve means and where the economy is heading because of that. Because if this trend continues, it's going to be very easy and reasonable to predict a recession in the next year or two. And that means these overinflated asset markets like stocks and trophy real estate, for instance, two things that are priced for perfection all around the world, those things are at risk because they tend to fall hard at the onset of a recession. So if the yield curve is predicting a recession, and then it happens, we'll see another bear market in equities and another big correction in real estate prices. And then we'll see the governments of the world respond as the way they have for the past 30 or 40 years with massive amounts of new credit. The difference this time will be that they're starting from a point of incredibly low interest rates already. Interest rates are still negative in a lot of parts of the world, and they're still barely above zero in the U.S., which means the central banks don't have a lot of traditional ammunition. It used to be if interest rates were 6%, central bank could cut them to 3%, and that would stimulate the economy. But if you're at 0.5%, how do you respond? What they're going to do this time probably is to go sharply negative. We're going to have global, deeply negative interest rates at some point in the next down cycle. And that's phenomenally good for precious metals because normally, if bonds are yielding 6% and gold costs you 1% a year to store, then the cash flow differential between those two asset classes is immense, and why not buy bonds? Because you get sharply positive cash flow compared to gold in that kind of a circumstance. But if bonds themselves are yielding 0 or negative 1% or negative 2%, and gold is still costing you 1% to store, then these financial assets like bonds that pay you in a depreciating currency while costing you money to own them no longer look good compared to precious metals. So the advent of global negative interest rates will be great for gold and great for silver. So that's one reason to be optimistic about precious metals, because the governments of the world really have no alternative but to double down on the past couple of cycles, demonstrably crazy policies that they dumped huge amounts of currency into the markets by buying up stocks and bonds around the world was, really unprecedented and a really bad idea from the point of view of traditional economic theory. Pre-Keynesian theory, which is turning out to be right, says don't do stuff like that. It's a disaster because it distorts the markets. And pushing interest rates down to negative levels that was actually completely unheard of before this last cycle. So if we're going to double down on those policies, that means we're going to do things that would have seemed flat out crazy to economists of 20 years ago, and will be proven crazy by the results that we get from them. We'll try this stuff because we don't have anything else to do, but once they fail, which they almost certainly will, then we'll be left with capital controls and basically, financial fascism. It's going to be a really brutal time when the tools that the Federal Reserve and the other central banks have been using to mismanage the economy fail to get them their short-term results. So that's common, Elijah. It is impossible to predict exactly when it comes, but we're almost certainly heading into a time when the old tools don't work and the markets panic because they don't see any other fix on the horizon.
Definitely, and I think you were talking about negative interest rates in a recent article you wrote, and it was interesting because there was quoted, even Fed officials are now saying that maybe negative interest rates are a thing we could try in the next recession. I mean, correct me if I'm wrong, but it was actually Fed officials suggesting that, right?
Yes. Well, see, basically what they're trying to do now is plan for the next time around, because they see that we're in a long recovery now. We're like 8 or 9 years into a recovery, when recoveries usually last about 6 years. So this is an old expansion, one of the longest on record, which means just because of the normal business cycle, leaving aside all the crazy economic policies that are in place around the world, just the normal historical business cycle says we should have a downturn at some point. We should be building up imbalances that will lead to a recession, which means the Fed is going to have to act at that point to stimulate the economy. And they're trying to figure out how they're going to do that. If, short-term interest rates are maybe 2 or 3%, and long-term rates are also 2 or 3% in the U.S., where do you go from there? There have been examples around the world of countries going a lot further. Japan just pegged their 10-year treasury rate at 0 and offered to buy as many treasuries as it takes to keep it there. In Europe, German bonds were negative almost across the yield curve. So we can go further. And the guys at the Fed now are starting to put out these trial balloons where they're starting to announce that maybe we should do that, or suggest that maybe we should do that next time around, to see how the market responds. And Janet Yellen, meanwhile, is on record as saying she would really like to have some policy tools that involve buying equities, basically. She would like to be able to intervene in the stock market when the time comes. And we will almost certainly see the Fed do stuff like that because there's nothing left. Just cutting interest rates from 1 or 2% or 3% to 0 again won't do much because they've been at 0 for quite a while and didn't really buy us all that much. And, we've taken on all this extra debt, which means we need an even bigger dose of monetary heroin to deal with the bigger bust that comes from much larger numbers, much more bad debt. So at some point, these things are going to be proven to fail. But the Fed, having no other tools, is planning to double down on the current set of tools. So that's what, when you see a Fed head speak now, that's a lot of their goal is to convince you that the stuff they're going to do next will be more extreme versions of what they're doing now, and it'll be okay, because the old stuff was pretty successful, all things considered. We're not in a 1930s style depression. And they want you to ignore the fact that it required, a doubling of the U.S. national debt, an almost quintupling of Chinese total debt to get us here, and a huge increase in debt and unfunded liabilities in Europe. We needed to borrow huge amounts of money, historically huge, unprecedented amounts of money, to keep things going. And going forward, we need to continue to borrow even more money year after year after year. And at some point, there are no tools to stave off the debt collapse that comes from this kind of leverage. If we, going into a recession, already have record consumer debt in the U.S., record auto debt, record student debt, record corporate debt, and record government debt, taking on huge amounts of new debt is probably not going to be the thing that brings back the normal times of the 1980s and 1990s, when we basically, grew steadily and there were lots of jobs. Those times can't come back under the current regime. And the Fed kind of sort of knows this. They're using flawed models that literally don't pay any attention to debt. So they don't see this as clearly as people who are outside of the the current economic mainstream do. But I think they're worried. They know that they're going to be trying unprecedented things in the next recession, which means there's no guarantee that these things work because they've never been tried on this scale before. So they're worried. and I think the fact that you've got central banks flailing around the way they are, debt increasing at exponential rates now, unprecedented rates, and the economies of the world not really growing as fast as you would expect them to grow with all this debt that's being pumped into them. These are good reasons to become really financially conservative now. In other words, buy safe haven assets like gold and silver and extremely well-chosen low-leverage real estate and stuff like farmland, things that will hold their value when financial assets, which depend on the value of these fiat currencies, really take a hit. So I think the days of gold and silver becoming the center of the global financial system are not that far off now. I think we'll have to go back to some kind of a gold standard, possibly with a cryptocurrency mechanism related to it that allows you to transfer wealth very easily. If we have gold stored in vaults as our base money in the system, valued at maybe $10,000 an ounce for gold, which is to say that the dollar would then be defined as 1/10,000th of an ounce of gold. And a Bitcoin-like mechanism for buying and selling and spending that gold, then you've got a really interesting post-fiat currency monetary system there. And it'll be interesting to see if we can make that work technically. But I think there's a very good chance that something like that ends up being the monetary system for the next century.
Now, mentioning cryptocurrencies, if we wanted to maybe discuss your opinion on what's been happening with Bitcoin right now, because Bitcoin recently jumped above $8,000. And so what is your perspective on the recent price action we've been seeing in the Bitcoin market?
Well, I think Bitcoin is being treated by people as gold and silver used to be treated, as a place you put your money to protect it from the mismanagement of the fiat currencies that you own. And so in that sense, it's not really being transacted in very much. In other words, you don't go buy your groceries with Bitcoin. There are Bitcoin debit cards out there, but the way those things work is they cash you out of your Bitcoins, convert the proceeds into dollars, and then you spend your dollars with the debit card. So that's not really spending Bitcoin. That's selling an asset and then using the dollars that you get for that asset to buy stuff. That would be like me selling my Google stock and then buying a car with the proceeds. Well, the car dealer didn't take Google stock. It took the dollars that I gave it. And so that's where cryptocurrencies are now. They're not yet mediums of exchange in a broad-based way, but they are a store of value. And a really successful store of value. If you swapped out of your dollars and into Bitcoin at any time in the past decade, you're really happy right now. On the scary side of that process, new cryptocurrencies and quasi-cryptocurrencies called tokens and coins are coming to market almost on a daily basis now. So that's increasing the effective cryptocurrency money supply out there at an exponential rate. And who knows what that does to the values of the various cryptocurrencies. It might just be such a drop in the bucket because cryptocurrencies are still really tiny as a market compared to fiat currencies, so that you can increase the supply exponentially for years more before it bites, or it might bite soon. This is uncharted territory. There's no way to know what Bitcoin and the other cryptocurrencies do in the short run and the intermediate term, because we've never done this before. We've never had a completely new kind of money that's totally derived from and controlled by the private sector emerge, at least not since gold and silver 3,000 years ago. So it's a fascinating thing to watch, and I love conceptually the idea of private sector money that completely bypasses the regulatory apparatus of governments and central banks. But based on bubble dynamics, I see a lot of similarities between what's happening in the cryptocurrency space and what happened with junk bonds in the 1980s and tech stocks in the 1990s and houses in the 2000s. There's not the probably wise amount of skepticism there now, and that doesn't mean that these assets won't work and won't become huge parts of the global financial system in the future. But it does mean that, it's kind of hard to figure out what a good price to pay is now for these things. and so people need to be cautious and careful and diversify, with Bitcoin, just like they do with any other asset class. In this case, you don't really have a lot of historical precedent for valuing these things, which adds a new layer of complexity and caution to the way you should approach this stuff. But I do think it's a fascinating thing to watch, and it's likely that blockchain technology, or whatever comes after blockchain technology, will play a big role in the global financial system in the future, and it might play a role in replacing the fiat currencies of the world, and not a moment too soon. These things are a failed experiment that deserve to be tossed into history's trash can.
All right. Well, John Rubino, thank you so much for joining us today. I guess before we let you go, did you want to share with the viewers where they can find you and any last thoughts you'd like to add?
Yeah, I run dollarcollapse.com, which covers lots of this stuff on a daily basis. And as for final thoughts, there are so many. Let's just save them for next time we talk.
All right. Sounds good. Once again, John Rubino, thank you so much for joining us today on this week's SD Metals and Markets Wrap.
Thanks, Elijah.